I don't admit to you knowing everything. There are times where I find myself very, very confused, and I turn to this guy right here, Dr. Matt Will, economist at the University of Indianapolis. Guys, welcome to the show. Good to be with you. Presented by Americans for Prosperity, AmericansForProsperity.org, economic liberty, free speech. That is where it's at. Dr. Matt Will is an economist at the University of Indianapolis, and I came across a story that I thought was, well, at the first, just fine. It was a story earlier today that the New York Fed saw inflation easing and how good that was and how important that is. And the New York Fed finds that Americans' inflation worries, and I'm quoting here from Fox News Business or Fox Business, their worries, quote, have reached the lowest point in over 2 years. And that's part of a story that led to a part two, consumers pessimistic about credit as inflation expectations ease. Well, wait, if the inflation is going down, why is anybody worried about anything? I thought this was the good thing. So I reached out to Dr. Matt Will with a simple text, just this article, to which he sent me so much information. I said, we should talk right here and right now. This is actually not a good sign to you. This sign that credit is not flowing, that's the real indicator that the recession is here.
Well, that it's here, Tony, or that it's about to be here. I mean, this report, the Consumer Expectations Report, is a very important report, but it's also very nerdy. You know, not too many people dig into it, so I'm impressed that you found this thing and started looking into it. What it indicated is that there's a coming credit crunch. A credit crunch is actually an economic phrase that we talk about, and that is a squeeze on the ability of consumers and businesses to obtain credit. And this isn't just now. We've seen this. We've talked about it, Tony, not directly, but indirectly in previous conversations about Janet Yellen when she told banks, stop lending money. And you may have recall, I went nuts when I heard that, because that is the fuel of the economic engine is credit. And she said, stop lending money. And I said, it's going to cause a credit crunch. And guess what, Tony? We now have a credit crunch.
Sorry. Now, this is from Investopedia, right here, about what these terms actually mean. A credit crunch refers to a decline in lending activity by financial institutions brought on by a sudden shortage of funds. So it's an economic condition in which capital is hard to secure. Banks and other traditional financial institutions become wary of lending to individuals and corporations as they are afraid the borrowers will default. This causes interest rates to rise as a way to compensate for the lender taking additional risk. Now, look, I don't claim any level of expertise here, but it seems to me that inflation was causing interest rates to rise because you increased the interest rates to bring down the inflation. Now you're telling me when people aren't worrying about inflation, they're going to have a tougher time getting capital. And if they do get capital, it's going to be a higher rate because the banks have to charge a higher rate because there's less capital actually to lend.
Yes, Tony. I mean, the rates are going up for two different reasons. I know this is scary, but there's other reasons rates could go up as well. The first reason we've talked about, and that is to battle inflation. Put that aside. Forget about it. This report even says people are less pessimistic. Oh, Tony, they're still pessimistic, just not as much. Then bring in the credit crunch that was created by Janet Yellen. And so this credit crunch means that it's harder for you and I to get money. Banks don't want to lend. The Fed is putting rules in place. They're concerned about your risk because if there's a recession, Tony, you may not pay back your loan. Now, let me tell you something that I've heard from bankers, from the credit industry. Banks are reducing the amount of money they loan. They're reducing the amount of credit available to their customers. They're eliminating lines of credit completely. Who's stepping into the void? What we call private credit. Now, these aren't loan sharks, Tony. Don't people may make an assumption. But private credit is not a bank. They're private investors, and they charge a higher rate. And that's where these higher rates are coming from, Tony, because banks are leaving the credit market.
That's exactly where we come to the question of, is this it? people looked at the inflation and they haven't seen the inflation go down. So maybe before we get into, is this it? Is this the prime indicator of recession? Let's get back to what the New York Fed has said, that a survey of Americans says, you know what, the inflation fears, they're lessening. Does that mean that inflation itself is lessening?
No, Tony. In fact, you have to read the report. You saw the headline and you read the news report. If you go read the actual Fed report, which I did, they said expectations for inflation over the next 12 months are still above 4%, Tony, but they're lower than they were a year ago. But 2 and 3 and 5 year expectation for inflation are higher. So the consumer believes, Tony, that inflation is here to stay for a longer period of time. And Tony, you said, you alluded to, is this leading to a recession? We have a recession, Tony. Last week, and I am mad that this didn't hit the news, last week, European Union officially declared a 2-quarter decline in GDP, an official recession as of last week.
Yeah, that did not make any news anywhere. Of course, we've been inundated with news about Joe Biden, and then those who don't want to report that only want to report the indictment of Donald Trump. And you know that news media only has time for the important narrative, one important narrative at a time. They can't do multiple stories about multiple things. Europe going with 2 negative quarters of GDP, which by definition is a recession. So now we get into this credit crunch conversation, this idea of consumers pessimistic. Shouldn't it be that the banks are pessimistic and the consumer could think that inflation is the inflation worries are easing, so everything will be better? It seems like it's an off headline from Fox Business. Shouldn't it be that the banks are freaking out?
Well, Tony, it's a chicken and the egg argument, because the banks are pulling back the credit because Janet Yellen has told them to do so. And also they see the risk of consumers. Consumers see this pullback, so therefore they're pessimistic about their ability to get loans. Businesses are pessimistic because they don't think they're going to be able to get loans. Tony, we saw this just a few weeks ago when U.S. auto sales, one of the largest national used car companies, said we're no longer going to be in business and have cars on our lots because we can't get lending. We can't buy inventory. Tony, what if you go to the store and you can't find anything on the shelf because the store can't get credit to buy inventory?
Whoa. Take a step back, because this I missed. Who said they're keeping cars on the lot because they can't get anybody to lend?
U.S. Auto Sales. It's one of the largest national companies for used cars. They announced, and we have a screenshot of it. They put it on their website. You can go to their website. It's still up there, that they told all their dealerships to send all their employees home, that they could no longer get what's called floor funding. That's the financing to put cars on the floor from their credit providers. This was big news. Well, it was big news in the financial press, but again, the mainstream media isn't covering this, Tony.
There's actually a headline from 11 Alive. It's called 11alive.com. Employees of U.S. Auto Sales shocked when asked to leave work as dealerships abruptly close in the Southeast.
Yes.
That seems very odd. So we're talking to Dr. Matt Will, economist at the University of Indianapolis. The idea that a bank won't lend to somebody, is this because the person trying to buy doesn't have any credit, or they don't feel it's sufficient credit?
Well, Tony, it's not an all or nothing. It's a spectrum. And so what you see is that banks are cutting back the total amount of credit they're offering. They're not completely eliminating. They're just reducing it in certain places. Why? Because their margins aren't that big to begin with, Tony. They're not making massive amounts of profit. And so they have to cut back where they're concerned about risk. Think about it, Tony. If you're a bank, isn't a loan lending to a used car dealership, isn't that kind of risky when you see the price of used cars going down, as we've seen, after they went up dramatically? And therefore, will I get my money back if I'm a bank? Again, that's just one of many examples, Tony, that are coming from your example that you sent me today.
Wouldn't I go the other way with it? The price is coming down, so it'll be easier for these people to pay it off because it costs less. That seems like an inverse conversation.
Tony, why is the price coming down? Because of lack of demand. That's why the price is coming. Why is there a lack of demand? Because people don't have the money to buy cars. You got to connect the dots. There's a lot more dots here than just, prices are down, they're cheaper.
I clearly, sir, have to start drinking. This because it doesn't actually make sense. It doesn't roll trippingly off the tongue. If the car costs less, but I'm still somebody who wants to buy the car, why would the bank not want to lend me the money if I can prove I can pay it back?
Well, Tony, if you can prove you can pay it back, but the loaning the money to you is the new problem you've identified in the article you sent me. The previous problem is, should they loan money to the dealership? Because can the dealership sell the car on their lot? That's the bigger problem, Tony. Why is the price down? The price is down because the company can't sell the car. Again, let me say that again, Tony. The prices are dropping on the lot because the dealer can't sell the cars. So the bank isn't going to loan them money if they can't sell the cars.
I misunderstood, because you're not talking about the end user like me who's going to buy the car. You're talking about the lot needing to finance the cars that they're buying.
Yes.
Well, that sucks. I don't know if that's a technical term, but it's the term I'm using right now, talking to Dr. Matt Will, economist at the University of Indianapolis. So you see signs like this and you say, okay, this is the sign of a serious problem. Now we're seeing this conversation about again, credit crunch. When we're seeing it as the definition went right here, a credit crunch refers to a decline in lending activity by financial institutions brought on by a sudden shortage of funds. The point I'm making is, where's the shortage of funds? A lack of willingness to lend is different than a lack of funds to lend.
Tony, they go hand in hand, because the federal government through Janet Yellen has told banks to stop lending money. I'm going to repeat this until I'm blue in the face. She said, stop lending money. The Fed has put tighter requirements after SVB. They put tighter requirements on banks, so banks are reluctant to loan money. That's where you get the definition that you just read, Tony, about a credit crunch. Less available funds. I know this for a fact. I talked to lenders and private credit lenders, and private credit people have said they have a lot more folks knocking on their door. More businesses are knocking on the door of private credit because public credit isn't available.
Let's go back to the Treasury Secretary, Janet Yellen. So these are some comments she made a few months ago. We're going back to March, being asked the questions by Senator Langford of Oklahoma.
Will the deposits in every community bank in Oklahoma, regardless of their size, be fully insured now? Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVB just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is your plan?
Made that determination.
Right. So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening.
It seems that's exactly the thing. It seems exactly the thing that she did encourage. And to your point, Dr. Matt Will, here's that Reuters headline. I just found it. Yellen says U.S. banks may tighten lending and negate need for more rate hikes. That goes back to April of 2023. That was when I first saw that Janet Yellen and this administration are not really in the business of trying to keep us out of a recession. And they're certainly not in the business of protecting smaller banks. They were starting to really show the favoritism there. Never mind the bailout of Silicon Valley Bank, Signature Bank in New York, and what we've seen from some of the others. But that part two that took place in April, a month later, you're saying that was really the alarm of, hey, everybody's about to tighten, things are about to become obscene.
In fact, Tony, they're not about to become. She ordered them to. She said, stop lending money. Tony, think about this. When you go to the store to buy clothes or you buy jewelry or you buy anything for your family, they have to have inventory. They don't have tons of cash sitting around, so they get lines of credit. They borrow a little bit of money. They make their inventory. You buy their inventory. They pay back the loans. Janet Yellen told them to stop borrowing money. Tony, nothing could be more insane for the economy than to tell people to freeze credit crunch. The Fed reported that it exists. Janet Yellen ordered that it exist a few weeks ago. I do not understand it. This administration is not in touch with the reality of the economy.
So now where does this take us, right? So a little bit of crystal ball conversation, but I think that if we're already seeing these things play out in, for example, in the car market where we're telling the used car dealer, no, you can't have the cash to go buy used cars because the price is coming down. We don't feel there's going to be enough people. You're going to have problems paying it back. So we reduce the credit there. Give me another industry where we're going to see a reduction of credit. And then how is that going to trickle down to our everyday lives?
Okay, Tony, let me be careful about being too pessimistic. First, let me be pessimistic and say it's going to be in any kind of company that has inventory, any retail business. But remember, I talked about the battle between Biden and Powell. Now let me talk about the battle between Biden and the growth and the ingenuity and the innovation of the U.S. economy. Because you have these companies like AI, NVIDIA, that are being much more productive. They're being very positive. They're causing the market to go up. They're causing productivity to increase. They're increasing the size of the economic pie, in contrast to an administration that's trying to shrink the pie. It's another battle that capitalism is having against this administration.
Because this administration is not capitalism friendly. So when Janet Yellen said this, what should she have said instead? Because I think one could make the argument that her point was we need to get less cash into the system so we can bring that inflation down. That would be the overarching theory of why she would say something like that. What should she have said instead? And if you say to me, nothing, just do nothing, let the market work itself out, that's my answer. So you don't get to give my answer. You have to give a more economist kind of answer.
Okay, if I'm not allowed to say she should say nothing, and I do believe Washington should just get out of the way. Wall Street and Main Street should be on the headlines, not Washington, D.C. So whenever they speak, they cause problems. But I'll tell you, if she had to say anything, Tony, it should be grow businesses. We talk about cash and stuff. Well, Tony, grow more stuff. That's the free market capitalist approach. Cut taxes, reduce regulation, grow the economy. Because if you have more stuff, Tony, then you can handle more cash. I've told you before, Trump was a spendaholic. Not as bad as Biden, but he spent way too much money. But the economy grew, so they could sustain that increase in cash because the economy was growing. It's not the same situation now.
One of the questions that I got as we're having this conversation is from Freddie. Is this the beginning of the end for banks? As you see, I mean, we've already seen some banks go under. We've already seen some bailouts. And we know not every bank is going to get a bailout, as Senator Langford got Secretary Yellen to admit there, as we just shared that. Are we about to see banks start going under in some way? Because if they're not lending, they're not making any money.
No, Tony. The answer is no. Do banks go under? Yes. Will some continue to? Yes. They go under every year. That's the normal process of the economy, the free market. But no, the banks, especially the regional banks that we have here in the middle of Indiana, these are solid banks. I've looked at their financial statements. They have good balance sheets. They're not at risk. I'm not concerned about banks going under, Tony.
What are you concerned about?
I'm concerned that this administration will continue to destroy the economy. They'll put more regulations, more taxes. Tony, this administration even announced from their own official reports in the last 2 months that we will have rolling brownouts across the country because of a reduction in energy. This administration has reduced the amount of energy since the day he got in office with his first executive order. And as a result, we don't have enough energy to supply the country. That is absurd.
Dr. Matt Will, economist at the University of Indianapolis. Before I let you go, I'm looking for something concrete here. As we see this credit crunch begin, what ends it? Meaning exactly how long, to the extent that you can decide exactly, how long does this go on? Because as we've just now described it, inflation isn't going to go down. Certainly interest rates are not going to go down. How does this end?
It ends very simply, Tony, when banks think they will get paid back. Now, when will banks think they will get paid back? When the government gets off the neck of the consumer and stops stepping on the neck of businesses. When they see businesses have the freedom to flourish and be prosperous and be innovative, that's when banks will lend again. But they're afraid they won't get paid back as long as the socialist agenda continues.
That is Dr. Matt Will, economist at the University of Indianapolis. I appreciate you, sir, as always, and appreciate you guys being here and being with us. My thanks to Americans for Prosperity, sponsoring what I do over here, americansforprosperity.org, economic liberty and free speech. That is where it is at, economic liberty. For now, I guess that's the name of the game. Guys, I appreciate you. I appreciate you subscribing to the channel here on Rumble. Even if you're watching somewhere else, get on over to Rumble and subscribe and be a part of what we're doing. Appreciate it very, very much. I'll catch you next time. Take care.